Hello, everyone. Welcome back to Financial News in Palos Heights. And I'm Ron Jankowski with Channel 4. And, of course, we have Paul Munichel from Ameriprise Financial. And we're going to talk about what took place. And Paul's going to give us some details last week, Paul.
Thanks, Ron. Today we're going to talk about Q1 earnings estimates and how the estimates have been revised down, still to a positive 1.6% year over year, but more cuts are probably likely. S&P 500 companies are now forecast to see Q1 earnings per share growth of just that positive 1.6% on sales growth of a positive 4.5%. At the start of the quarter, looking around January 6th, analysts had estimated Q1 earnings growth at 4.8%. Estimates for the current quarter almost always come down during an earnings release season, but of course, the bulk of the current pressure derives from the considerations related to ongoing coronavirus outbreak. Estimates are very likely, in our view, to drop further in the weeks ahead as the outbreak continues to spread at this time. As we've previously mentioned, investors should consider that this situation is very likely to prove temporary, but of course the near-term risk to financial markets and economic activity are notable. The economic implications could also linger for months or quarters beyond. Through last Friday, 422 or 88% of the S&P 500's current 505 companies had reported their results for the fourth quarter, and according to FactSet, the Q4 blended growth rate for the S&P 500 earnings per share now stands at a positive 0.7% on sales growth of 4%. At the start of the release season, earnings per share estimates were forecast to decline by 2.1% on sales growth of about a positive 2.4%. Over the next 2 weeks, retailers, a segment that is likely to be more heavily impacted by the coronavirus situation more than others, will offer their results. Given the current circumstances, the outlook provided by many of these firms should be expected to place further downside pressure on the aggregate consensus estimates and likely bring down consumer sentiment as well.
And Ameriprise Financial also supplied us this morning the morning notes, and today being February 24th, 2020. Paul, I swear all of our information that we're talking about today is all basically being affected by the coronavirus.
Coronavirus is the talk of the town, it's the news of the day, and it's definitely what's affecting the market so negatively this morning.
Yeah, the market, before we went on the air this morning, where did it land?
We're down pretty significantly in the 3% range when I left to film show today.
Okay, well, here are the notes that have been provided to us. Global equity markets are sharply lower after the number of coronavirus cases outside of China grew, stoking concerns over a global economic slowdown. And, of course, that's basically what we just chatted about. The S&P 500 futures are lower by 2.4%, while the Europe's stocks 600 index shed 3.3%, its worst day since 2016.
Those are pretty significant drops, 2.4% and 3.3%. And like I said, when I left this morning, we were down about 3%. So we seem to be in line with the rest of the world, and that may be what you could expect to see from our markets today at the close.
And the yield on the 10-year Treasury fell below 1.4% as investors move into safe haven assets. And, of course, that's going to happen at this point.
That's common. We talked about that last week.
Yeah.
We've talked about coronavirus to our viewers every week for weeks we've been talking about this. The thing about that is mortgage rates will drop because of this. So if you haven't refinanced in a while or looked at that, maybe something
you better
worth
consider
considering.
it. Yeah. A note that they also pass on to us, software maker Intuit is nearing a deal to buy Credit Karma for $7 billion per CNBC. If you're into that investment, you may be that may be of interest to you, which most small investors would not even be part of that. The S&P 500, I'm going to talk about the World Capital markets, Paul, where they're at year to date. The S&P 500 is a 3.59% plus. A Dow Jones is a plus 1.96%, and the Nasdaq Composite is a plus 6.94%. Still, we're solid.
Yeah, but unfortunately, those numbers don't include today's drop yet.
No,
which
they
could
wouldn't.
potentially wipe those all out
Yep,
for the year
yep.
today.
Well, the news next week, Monday, when we do our show, a lot of this will have significant changes, I'm sure.
Yes.
Okay, that's it for today. We're going to be coming back with our other show called Your Money. Paul's going to be talking about the potential tax benefits of company stock in your 401k. Stay with us. We'll be right back. And we're back with our show called Your Money. And again, as I had mentioned, Paul is going to be talking about the potential tax benefits of company stock in your 401k plan. And Paul, I'm going to let you take it from there.
Thanks, Ron. You know, if you own a 401k account like many Americans do, and oftentimes that's going to include company stock, chances are you'll someday need to decide what to do with that stock. This decision comes into play for people who are retiring or otherwise leaving their employer. Whatever the case may be for you, it's important to understand your options when determining whether and how to move company stock out of your 401k. It's also worth exploring whether an easily overlooked provision in the U.S. tax code could help you manage your tax bill when the time comes.
And Paul, what do you need to know about an IRA rollover?
Several things. So many people leave their employer. They choose to roll over their entire 401k plan account into an IRA, including all of their company stock into that IRA. If this transaction is completed in a proper manner, it can be done with no immediate tax ramifications. However, it's important to understand that any future withdrawals from the rollover IRA will be taxed at ordinary income tax rates, which can range from 10 to 37%. And those who take a taxable distribution prior to age 59 and a half may face an additional penalty of 10% on that withdrawal, something that should be taken into serious consideration prior to making such a move.
And Paul, what about capitalizing on net unrealized appreciation rules?
Good question. Another strategy for moving company stock out of workplace retirement plans that makes sense in many cases but is often overlooked involves net unrealized appreciation, commonly referred to as NUA. NUA represents the difference in value between your average cost basis. In essence, that's the price initially paid to own the shares of the employer stock held in your retirement plan and the current market value of those shares. Now, under this strategy, rather than rolling your company stock into an IRA, you separate it from the rest of your 401k holdings and take it out as an in-kind distribution. You will owe tax on the cost basis of the stock at the ordinary income tax rate. However, the appreciated value of the stock, the NUA, will remain untaxed until you liquidate shares of the stock. In that event, you will be taxed at the generally more favorable capital gains rate, currently no higher than the 15% bracket. Dividends will be taxable on an ongoing basis, but possibly at a more favorable qualified dividends rate. And in certain circumstances, taking a lump sum distribution of employer stock and invoking NUA provisions could result in long-term tax savings. So importantly, it's best to wait until 59 and a half, because completing this transaction prior to that age will incur a 10% penalty and early withdrawal penalty.
And so what we're really saying is you need to check your 401k and pay attention to it.
Absolutely. I mean, you've got options. It's more than just rolling it like that. Take a closer look at the assets held in your 401k plans, which both current and past employers. If company stock is included, you may want to consider which strategy, a rollover of the full amount lump sum to a IRA plan, or using the NUA rules, whatever is more effective for you. Check with your plan administrator to find out more about the details of the stock position you own. Also consult with your financial and tax advisor before taking any action on any rollovers or transfers.
Okay, Paul, what about if a viewer has a question?
Questions, feel free to call me directly at 708-226-3412.
Okay, anything else you want to add to this?
Nope. I mean, again, we've talked about taxes here and implications with rolling it or taking distributions out. Please consult with a tax advisor before you take any action on anything involving rollovers or distributions or NUA calculations. That's all stuff that should be kept to a professional.
You know, of course, and you have to make sure you're of the appropriate age.
Exactly. 59 and a half is the key number to review before doing anything.
Thank you again, Paul, for coming out with this topic. For Paul Munichel with Ameriprise Financial, myself, Ron Jankowski with Channel 4 in Palos Heights, we wish you good investment day.